Welcome to Day Zero with FOUNDIT. Today we're having a conversation around how Joel and the team are progressing around understanding data, understanding what the economy's done, both a forward-looking view but also what's happened in the past as well, to provide some kind of future indication of what might be a hint of where the market's going. Welcome to Day Zero. Over the past few weeks and months, Joel's been working with a number of people, such as economists, such as some of our data scientists, to think about how we bring together a model that is scalable, firstly, but more important is accurate so that we can rely on data. Joel, what are some of the interesting things that you've already bounced into?
So I think it depends on the client. So if we're doing work for investors, I think one of the challenges is there are so many suburbs in Australia that you could potentially look at investing into, but you kind of need to actually figure out, like, how do you put some science behind, like, identifying these suburbs to begin with? And so first and foremost, like, we've actually just been trying to capture as much data as we can at a suburb level, and then what's called an SA3 level, which is kind of a more broader geography that captures a lot of suburbs in it, so that we can actually kind of normalize the data a little bit, because some suburbs have got good data, some suburbs have bad data. So we've been just working over the last sort of 6-12 months on actually, like, capturing as much of this data as we can to actually build one of our models ourselves. Because I think one of the issues with a lot of the sort of data providers that are out there that help investors identify suburbs is we weren't able to figure out, like, how it sort of came to an output of, like, this is where you should be placing a client or thinking about investing into a particular suburb. We weren't able to really understand, like, what drove that output. It was kind of like a bit of a black box. So the way that we've kind of gone about things is, first of all, start with data at the suburb level. And we're basically looking at, like, from a historical perspective, up until COVID, we had relatively normal kind of economies playing out. But then after COVID happened, you obviously had very loose monetary policy. You had very large scale stimulus at the government level as well. And so that actually caused a lot of dislocation in asset prices globally. And so it's actually not a very good representation to look at, like, where prices are today without having some kind of, like, baseline understanding of, okay, before COVID, you had kind of markets growing at anywhere from sort of 5 to 8% annually. Currently, you've actually seen a complete dislocation where you've got some regional markets, like, for example, Gladstone, Bundaberg, just to name a few. They're trading at like 50% premiums to their long-term averages.
And just to simplify that, what do you mean by long-term averages?
If you look at the property market in two worlds, there was kind of the pre-COVID world and then there's the post-COVID world. So if you look at take the Gladstone market, pre-COVID, it would have been trading at a certain long-term average, 7-8%. What's actually happened is, since COVID, you've had rates drop to zero, which has caused a huge spike in asset prices. And then you've also had a large amount of immigration that's come into the country as well, relative to a undersupply of new dwellings. And so, you know, this supply and demand thematic that's been playing out has kind of caused, decent increases in property values, just more broadly. And so what we want to try and understand is, what was the long-term average that these suburbs were growing at before rates went to zero? And then we basically model that out, and then we'll look at what current values are currently trading at. And then that creates a gap, essentially. So you'll be able to see what is the gap between the long-term average of Bundaberg and where it's trading at today. And that gap is currently about a 50% premium over the long-term average. Conversely, you've actually seen a negative thing happen in Victoria, just due to recent legislation changes, which have kind of made it less profitable for property investors down in Victoria. It's caused a lot of investors to leave the market, which has increased supply, which has dropped the actual median sales price in many suburbs. And so what you're actually seeing is, if you plot that same long-term average at the suburb level for many of these suburbs in Victoria, it's actually the median values are actually trading below that long-term average. So you've really seen quite a significant impact for the Victorian market. And so we're actually relatively bullish on a number of suburbs in Victoria just based off of what's kind of occurred over the last sort of 2 or 3 years.
How does that, and we were chatting about this the other day with some of the guys around, how does yields play into that in relation to when you're looking at across the whole country? Do you look at it? Do you take it into consideration? Do you look at it in comparison to like Brisbane at the moment and how that's trading against yield versus Melbourne?
Yeah, I mean, I think if you actually look at the major cities and their rental yields, you can kind of see that Melbourne's rental yield is actually completely spiked. So it's currently trading at like a sort of 3.7% rental yield. And historically speaking, that's actually very high. Usually Melbourne and Sydney have kind of tracked close together in terms of their rental yields. But at the moment, I think Sydney's rental yield is like sort of 2.9 or 3% or something like that. So it doesn't seem like a lot. Melbourne trading at 3.7% yield and Sydney at sort of high twos. But the difference is actually quite significant. So if you do actually see rental yields in Melbourne compress from 3.7 to 3, you can potentially see capital appreciation of sort of 20, 30%.
Yeah. So how does that play into how you're thinking about for an investor client and what it might mean for them in terms of where they should be looking and what suburbs they're looking at? And I think your point, interesting, was before, even if you didn't want to use a buyer's agent, you want to be an investor and you're going out into the market, the danger I think that you identified is just looking at suburb level and not actually coming up to SA3, and why that is important as well.
Yeah, I mean, I think the purpose of looking at all this data is just to try and minimize the noise and just kind of make sense of some of the events that have taken shape over the last couple of years. And so for us, like when we're looking at some of this suburb level data and we see Gladstone trading at 50% premiums to its long-term average, it's not to say that it's a bad place to invest. We're just saying that it's high risk. And so like we're just cautious around some of those areas. They're still relatively affordable. Like they trade at like sort of $550,000 median values in those areas. So, they are still relatively affordable, especially when you kind of overlay some of those affordability measures, like what's the median income in those areas, and trying to understand what's the kind of monthly loan repayment versus median incomes. It's not like terrible, but it's more just, if you look at prices spike that aggressively, usually there is sort of a period where things cool down. So it might just be that it's kind of flat growth for the next couple of years. It doesn't necessarily mean that it's going to go all the way back to its long-term moving average. But we're just kind of mindful of some of these elements when we're looking at identifying suburbs for investors to consider buying into.
Does it play in differently to how you think about an owner-occupier and how looking at an asset level for them, or is it very similar in the methodology that you're forming on it?
Well, yeah, I don't think owner-occ clients that we deal with really, they don't care too much about us doing a bit of a overview on like nearby suburbs that might be better value. I mean, sometimes, but most of the time you've got clients that are kind of pretty set on wanting to buy in South Yarra, or if you're in Sydney, they want to buy in, Edgecliff or whatever it might be. So then it's really about asset level due diligence more than anything. And so our approach there is, we want to at the very least give our clients the same kind of due diligence that a vendor would get on the sell side. So typically when a sell side agent has a client, they'll give them a CMA, which is a comparable market analysis report, which just has recent sales in the area. It might have breakdowns of like distributions of price segmentation to give you a sense of where relative value is at a median level. So we do all that sort of stuff often for free for clients, but where we kind of take it to a much deeper level is we'll actually look at sales data for the entire suburb going back at least 12 months. So we have a really holistic view of what is actually happening within a market, and where is the market actually buying and selling properties at a given number of bedrooms or whatever it might be. From there, we'll also basically drill down and really understand like what are some of the other factors that affect a suburb's value. And so we spend a lot of time looking at like points of interest and things, nearby amenities. We look at noise pollution maps. We look at nearby public housing composition. So we really like to give our clients a very detailed understanding of exactly what's going on within a certain suburb. And it's usually over a sort of 15 to 20 page report covering quite a lot of detail.
What are the other things you need to be considering and looking at when you're looking just on a property level, or as you describe it, an asset level? Is it things like owner-occupiers versus investors in the street? What are the other pieces of data? I know one of the hardest things that you've found is that it's really hard. In fact, it's near impossible to go to one data source and actually get it from one place. You've got to be working out of a few different systems in order to try and bring that whole holistic understanding of the property and also the suburb together collectively to make a really informed decision around what you're getting yourself into. What have been some of the learnings in what you're looking at with the team and different things that they've identified that needs to be taken into account as well?
Yeah, so I mean, you're right. We use probably at least half a dozen different data providers to try and, give a better picture of a suburb, because within a suburb, there's so many different pockets that have different valuations at a street level even. So we actually have data that can actually identify like which pockets within a suburb are actually more expensive than others. And often there's actually really high correlation between a pocket within a suburb that's at a significant discount to another pocket, and it's usually something to do with there might be higher levels of public housing nearby, there might be higher noise pollution, could be on a main road. So there is usually some level of correlation, which does kind of play into why certain pockets within a suburb have higher premiums. I think as well, like we actually love to do a lot of like price segmentation. So we'll have a look at like the distribution of sales within a suburb to try and identify where does the target property sit within that distribution, because ideally you don't really want to be buying a property at the higher end of that price segmentation analysis, because it means you're kind of at the limit of where the current market is actually buying property. It does depend, like it depends on how price sensitive you are, but if you're kind of looking at relative value, we're always really interested to try and be buying sort of in the middle or at the lower end of that price segmentation analysis, because it just means that if you're in a really attractive suburb, naturally those segmented parts of the market are going to experience higher levels of capital growth than some of those higher end, more extended parts of the market.
And when you talk about product type, you to break that out, what are the things you're thinking about? It's like new build versus existing versus renovated versus standalone, freestanding, I should say, or semi-detached. So those are the segmentations you're looking at?
Yeah, I mean, we focus more on condition. So we'll have a look at properties, and usually we try and not overcomplicate it too much. So we're looking at like fully renovated homes that are in nice condition, and then homes that are in poor condition. Like it's very sort of high level, just to kind of get a sense of like what is the market paying within these certain segments of the market. And usually it's actually pretty accurate in kind of capturing like where relative value is for a certain condition property once you've kind of done this segmentation analysis. But you do need a relatively decent sample size in order for it to work. If you've got a suburb where there's very low volume of transactions, you probably have to broaden out your data set going back more than a year. And then you probably have to do some indexing as well, just to make sure that the prices actually reflect kind of where markets are trading at today.
So let's put it into real life terms. Let's talk about, we won't say the address, but the properties in South Melbourne that we did some work for a client on recently. Some of the things that they found out going in on the surface, which was, I think, a $4 million home or close to, and what we uncovered in the process of actually looking at that property and following that process as well.
Yeah, I mean, it's a property that a client was looking to buy, wants to start a family. South Melbourne it's a blue chip suburb. It's on the right next door to the city, great accessibility, good restaurants everywhere, near Albert Park Lake. So, it's a terrific suburb, but again, this kind of played into what I was saying before around even within a suburb, there's lots of different pockets. And when we actually had a look at the median price by pocket, we saw really nearby that there was $1 million price difference between the pocket where we were looking to buy and the pocket just next door, which is a street away, 2 streets away. And the more we digged into it, the more we realized that 2 streets away in that pocket, roughly 1 in 2 homes was public housing. And so you can just clearly see that there was just a very high correlation between that and how this property was actually priced. Whereas we had a look at sort of the more expensive part of South Melbourne where median sales were, roughly $3-4 million. And, public housing is virtually zero. So this level of granular data sometimes just gives you the answer that you otherwise wouldn't be able to figure out without it. So it's all about just really delivering context for the client and for the buyer's agent.
Joel, it's been another interesting conversation. I think the key takeaways has been looking at Melbourne, thinking Melbourne's probably a buy right now in some of these with some real key factors sitting with there. Be cautious around regional markets that might have had a really exceptional run over the last few years. Doesn't mean they're a bad buy, but it's something you've got to be aware of. And also just not relying on a few comparable sales, as I always continue to say, making sure you're looking at a variety of different data points. Is an owner-occupier versus investor-led street? How much social housing is in that street and their surrounding areas? What are the different things around public housing and other demographics or key data points, I should say, around like noise pollution and other things that will play into whether this is going to be a good long-term asset to be getting into as well. And even so, some of the reports that you're doing, you're finding that people get the information and then they're continuing to proceed because that's where they want to be, and that's fine, but as long as they have the right information at their disposal. Joel, thanks for coming on Day Zero again.
Thanks for having me.